Hey everyone, welcome back. Ready for another deep dive.
Always ready. Let's get into it.
Awesome. So today, we're looking at the Singapore stock market.
Yep. Should be a fascinating one. Plenty going on as always.
Definitely. It seems like every day brings something new. Lawsuits, falling profits,
Mhm.
currency woes. It's all happening.
That's the beauty of it, isn't it? It's a constantly moving target, the market. Keeps you on your toes.
That's for sure. So, how'd the market actually do today overall? Big picture first.
Well, the STI dipped a bit,
Yeah.
down by 0.6%. Not a huge drop, but doesn't paint the rosiest picture. Some of those big names took a hit too. NIO down 5.5%, Singtel 5% down as well,
Yeah.
and Wilmar International, they're down 4%.
Wow. Okay, so those are some pretty significant drops. I mean, is there any specific spooking investors today, or is it just kind of a general feeling of unease?
Well, each company has its own uh, set of challenges, right? Company-specific stuff. But sometimes sentiment plays a role as well. Can be a bit contagious. If the overall market mood is a bit shaky, investors might be more likely to pull back, even if a company's fundamentals are solid.
Right, makes sense. So let's talk about one of those companies you mentioned, Singtel. They're making headlines because their Australian subsidiary, Octus, is facing a pretty serious lawsuit.
Yeah, Optus is in hot water. And it's not just any lawsuit either. This one's from the ACCC, the Australian Competition and Consumer Commission. They're a pretty big deal down under. A powerful watchdog. And they're not messing around with these allegations.
Oh, I see. Okay, so for those of us who might not be familiar with the ACCC, can you break down who they are and why this lawsuit is such a big deal for Singtel?
Sure, so the ACCC is basically Australia's consumer protection agency. They have pretty broad powers to investigate and take action against companies that engage in misleading or deceptive conduct, anti-competitive behavior, all that sort of thing. They're not afraid to go after big companies either.
Okay, so this is not something Singtel can just brush off. So what exactly are they alleging Optus did? What is the heart of this lawsuit?
Well, it all boils down to what the ACCC calls inappropriate sales conduct. Basically, they're accusing Optus of some pretty shady practices, targeting vulnerable customers, people who might be more easily taken advantage of.
Oh, that's rough. I mean, what kind of penalties are we talking about here? What are the potential consequences for Optus and, by extension, Singtel?
Potentially hefty penalties. We're talking millions, maybe even billions of dollars. The ACCC is also looking for customer compensation, to make things right for anyone who might have been harmed by Optus's practices. And on top of all that, they could be forced to implement a court-ordered compliance program to prevent this kind of thing from happening again.
Wow, that's going to be costly, both financially and in terms of reputation. Has Singtel responded to the lawsuit at all? What are they saying?
Oh, yeah, they have. They've acknowledged the lawsuit. They've said they've disciplined the employees who were involved in the, inappropriate sales stuff. But they're also saying they can't really estimate the potential financial hit at this point, which honestly is understandable. It's still early days.
Right. It's all a bit up in the air right now. Okay, so let's move on to another company having a bit of a tough time today, Wilmar International. Now, they're a huge e-player in the agricultural world, a real powerhouse, but their profits just took a pretty big hit.
Yeah, a 19% drop. That's a pretty big deal no matter how you slice it. Seems like a couple of things are factoring in here. First, their operations in China haven't been doing as well as they hoped. And then their sugar division has also been struggling a bit.
Ah, I see. So even giants like Wilmar aren't immune to market forces. So how does this quarterly drop impact their overall yearly profits?
Well, even though their revenue for the year is actually pretty steady, that drop in the last quarter has pulled their yearly profits down by about 3.6%.
So even though they're selling more, they're making less. How does that happen?
This is where it gets really interesting. Commodity prices play a big role. You see, even if you're selling a ton of something, like palm oil, for example, if the price of palm oil drops, your profit margins shrink. Simple as that.
Got it. So it's a good reminder that revenue doesn't always tell the whole story. Profits are what really matters at the end of the day. So Wilmore has said they're cautiously optimistic about the future. What do you make of that?
Cautious optimism, eh? Well, I think they're hoping for a few things to go their way. Maybe those commodity prices will rebound. Or perhaps they'll see stronger performance in key markets, like China, for example. But I think the cautious part is key here. They're aware of the challenges, that's for sure.
All right, it's a bit of a wait-and-see approach. Okay, let's shift gears and talk about First Right, a real estate investment trust. Their DPU is down 6.5%, which might not mean much to some listeners. Can you break down what DPU is and why this decrease is significant?
Sure. DPU stands for distribution per unit. Basically, it tells you how much of the REIT's income is paid out to investors as dividends. So a lower DPU means investors get less bang for their buck. Simpler terms, less money in their pockets.
Ah, so drop in DPU is definitely not good news for anyone holding First Right. What's behind this decline?
Well, they're pointing the finger at currency fluctuations, specifically those foreign currencies losing value against the Singapore dollar. They have a lot of overseas holdings. So when they convert those earnings back into Singapore dollars, it's worth less.
The joys of global markets, eh? It's all interconnected. So what's their plan to deal with this currency situation? What are they doing?
They're aiming for a pretty big shift in their portfolio. Their goal is to have more than half of their holdings in those developed markets by 2027. The idea is that this will provide more stability, maybe even better returns.
So it's all about diversification, spreading the risk.
Exactly. Not putting all your eggs in one basket. And it makes sense, Developed markets, they tend to be less volatile, offer more predictability.
Makes sense.
Yeah.
So how do they plan to actually make that shift from where they are now to more developed markets? How does that happen?
They're going to be selling off some of their existing properties, stuff they consider non-core assets. This will free up some capital, give them some cash to go shopping for new properties in those target markets.
Interesting. It's like a real estate shuffle, right?
Yeah.
Okay, so far we've been pretty focused on specific companies and their individual challenges, but I'm curious to take a step back and look at the bigger economic picture here. What's happening in the region that might be impacting Singapore's market? For example, I know the Malaysian Ringgit is having a pretty rough month.
It is. It's actually on track for its worst month since, let me think, 2015, I think? Down over 6% against the U.S. dollar. And a lot of that has to do with uncertainty surrounding the U.S. election.
Yeah, that makes sense. Elections always stir things up a bit, don't they?
Yeah.
But I'm curious about how a weaker ringgit impacts Singapore specifically. What's the connection there?
Singapore and Malaysia, they're very closely tied economically. So when the ringgit weakens, it can affect trade between the two countries. Imports from Malaysia become more expensive for Singaporean businesses, and that can impact their bottom line, squeeze those profit margins.
It's a reminder that everything is connected, right?
Yeah.
Okay, another piece of news that caught my eye involves DBS Bank. Apparently, they might be financing the shutdown of some steel plants.
Yeah, it's an interesting development. They're considering providing funding to decommission those steel plants in both India and China, actually. And it's not just about shutting them down. It's about doing it in a way that's environmentally responsible, what we call transition financing.
Hold on, transition financing. What exactly does that mean? Can you unpack that a bit?
Sure. Transition financing is basically about directing money towards those projects that help us move towards a more sustainable economy. In this case, it's about phasing out those older, less efficient, and, often more polluting steel plants.
I see. So it's not just about closing down factories. It's about doing it in a way that considers the environmental impact.
Exactly. And for DBS, it's a smart move on a couple of fronts. First, it aligns them with that growing demand for sustainable investments, those investors who really care about ESG factors. Second, it positions them well for the future. As more and more companies prioritize sustainability, they'll need financing to make that happen.
So it's a way for them to appeal to investors who care about doing good, but it's also a smart business decision, right? Getting ahead of the curve.
Precisely. They're thinking long term. All right, last bit of news for today. Singapore's sovereign wealth fund, GIC, is apparently interested in a deal with PSG Equity. That's right. Both Canadian and Singaporean funds, including GIC, are considering backing a $1.8 billion asset transfer by PSG Equity.
Okay, break that down for me. What kind of asset transfer? What are we talking about here?
It's what's called a continuation fund. Essentially, it's a way for private equity firms like PSG to hang on to their investments for a bit longer, even after their original fund's lifespan ends. So they create this new fund, transfer those assets over, and bring in new investors to keep things going.
So they're basically extending the game. Why would they do that?
Sometimes they believe these assets still have lots of potential, but they need more time to, reach their full value. So this continuation fund allows them to play that long game. Hold on, nurture those assets until they really blossom.
Right, it's all about maximizing returns. So what makes GIC's involvement in this deal so significant? Why are people paying attention to this?
GIC, well, they're a huge MRE player in the global investment world. Their involvement can send a signal to other investors that, hey, This strategy, this continuation fund thing, it's worth considering. They're known for their thorough due diligence. They don't jump into things lightly. So their participation really adds legitimacy to the whole thing.
So they're like the gold standard
Yeah.
almost, the seal of approval.
You could say that. If GIC is in, it gives other investors more confidence, Like, hey, if it's good enough for GIC, it might be good enough for us too.
It's fascinating how much influence they wield. Wow, we've really covered a lot of ground today. From lawsuits and profit slumps to this whole transition financing and these continuation funds. It's a whirlwind.
It is, isn't it? The market never sleeps. Always something happening. But that's what makes it so exciting, right?
Absolutely. But definitely a lot to take in.
Well, we'll be back in just a bit to unpack some of the broader implications of these stories, so stick around. Thinking about this whole Singtel and Optus situation, it really brings up some interesting points about corporate responsibility, doesn't it? Especially when you're talking about protecting vulnerable customers.
Yeah, definitely. It's not just about following the rules, right?
Yeah.
It's about doing what's right, especially when you're dealing with people who might be more susceptible to, aggressive sales tactics or misleading information.
Exactly. Companies are under a microscope these days. Consumers are more aware than ever. They know their rights, and they're not afraid to speak up. And social media, well, that just amplifies everything,
Oh,
right?
yeah, for sure. It's like that old saying, sunlight is the best disinfectant. The more transparency there is, the harder it is for companies to get away with shady stuff.
I love that analogy. And for Singtel, this lawsuit isn't just a legal issue, it's a reputational one. They need to show that they're serious about these allegations and that they're committed to treating all their customers fairly.
Absolutely. It's a good reminder that ethical behavior isn't just good for, your conscience. It's good for business, too.
Hmm.
Okay, let's circle back to Wilmar for a minute. They said they're cautiously optimistic about the future, but what are the things that could actually tip the scales one way or the other for them?
Well, on the optimistic side, a rebound in commodity prices would be huge for them. If demand picks up, especially in China, their profits could bounce back pretty quickly.
Right, so they're kind of at the mercy of market forces to some extent.
Hmm.
What about the things they can control? What can they do to improve their outlook, even if the market doesn't cooperate?
Now, that's the interesting part. They could focus on becoming more efficient, streamlining their operations,
Yeah.
maybe even exploring new markets to diversify their revenue streams a bit.
Right, so it's all about having a plan B, maybe even a plan C. Don't put all your eggs in one basket. Makes sense. What about the flip side? What are some potential risks or challenges that can make them even more cautious?
Well, a continued slowdown in China would be a big concern. And, they're an agricultural company, so they're always vulnerable to things like unpredictable weather patterns, things that could disrupt their supply chains.
Ah, yes. Mother Nature doesn't always play nice with the stock market, does she? Okay, back to First REIT for a second. Their decision to focus on developed markets is interesting. Seems like they're trying to manage risk by diversifying geographically.
Yeah, that's a pretty common strategy, not just for REITs, but for investors in general. Developed markets tend to offer more stability, more predictability, though the potential for those really big gains might be lower.
So it's a trade-off, right? Lower risk, but potentially lower reward.
Yeah.
Are there any downsides to this strategy? Any challenges they might face?
There are always challenges. Competition for prime assets in developed markets can be fierce, so they'll need to be really smart about their acquisitions. And navigating those different regulatory environments, that can be tricky too.
Sounds like they'll need a skilled team to pull it off.
Let's zoom out again for a minute. I want to think about some of those global trends that might impact Singapore's market. We talked about the Malaysian Ringgit struggles, but what else should investors be keeping an eye on?
Well, the U.S. election is still a big wild card. The outcome could really shake things up, in the global economy. And that would inevitably impact Singapore.
Yeah, for sure. Beyond the election, what are the things keeping you up at night, economically speaking?
Inflation is still a major concern globally. Central banks are trying to, walk that fine line, raising interest rates to combat inflation, but trying not to tip the economy into a recession. It's a delicate balancing act.
I've been hearing a lot of talk about a potential recession. Do you think it's likely?
It's definitely a risk, but it's not a certainty. Economic indicators are giving mixed signals right now, so it's really hard to say for sure.
So it's a wait and see kind of situation. Pretty much. Prudent investors are staying informed, diversifying their portfolios, and just being prepared for different scenarios, Hope for the best, prepare for the worst.
Makes sense. Speaking of prudent investors, I thought DBS Bank's move into that transition financing was pretty interesting. What do you think about that strategy?
I think it's a really smart move. It aligns their business with that growing demand for sustainable investments, and it positions them to attract capital from investors who are really focused on those ESG factors.
Do you think we'll see more of this from other banks and financial institutions?
Oh, absolutely. Sustainability isn't a niche concern anymore. It's becoming a core part of investment decision making.
So it's not just about doing good, it's about doing well by doing good.
Exactly. And it's not just about reputational risk either. There's a growing recognition that climate change, those other sustainability challenges, they pose real financial risks as well.
Right, so for DBS, it's both ethical and strategic.
Yeah.
Okay, let's touch on GIC and that PSG equity deal again. You mentioned those continuation funds. What's driving their popularity?
Well, for private equity firms, it's a way to hold on to their best performing assets for longer, potentially generating bigger returns for themselves and their investors.
Sounds like a win-win. But are there any potential downsides to this? Any risks?
There are always risks. Investors need to be sure these continuation funds are being used responsibly. Not just as a way for firms to avoid selling off assets that might not perform as well on the open market.
So transparency and due diligence are key, as always. It seems like GIC's involvement in this deal could set a precedent and maybe encourage more investors to consider these continuation funds.
That's a good point. Their participation definitely adds a level of legitimacy and could make other investors more comfortable with this approach. But it's important to remember that every investment comes with risk, and continuation funds are no exception.
Right. No such thing as a free lunch in the market. We've really covered a lot of ground today. From individual company news to those big picture economic trends, investment strategies, it's been a true deep dive.
It has, and it really highlights how interconnected the market is. Local events can be influenced by global trends, and seemingly small decisions can have ripple effects across the entire financial system. It's all connected.
It can feel a bit overwhelming, honestly, but I also feel like I have a better grasp of what's going on, what to watch out for.
That's the goal. Investing isn't about predicting the future perfectly. It's about understanding the landscape, assessing the risks and opportunities, and making those informed decisions that align with your goals.
Well said. And speaking of goals, we're almost out of time for today. But before we wrap up, I'm curious to get your final thoughts. What does all of this mean for investors in Singapore and beyond?
I think the key takeaway is that we're living in a time of unprecedented change and uncertainty. Those forces shaping the market, they're complex and constantly evolving. There's no easy playbook to follow.
So what's an investor to do?
Stay informed, stay curious, never stop learning. We've talked about a lot of different companies and trends today, but it's just a snapshot, a moment in time. The market will keep moving, keep changing.
It's a journey, not a destination.
Exactly. And the most successful investors, they're the ones who can adapt and evolve along with it.
That's a great point to end on. We'll be back in just a moment for the final part of our deep dive. We'll reflect on everything we've learned and leave you with some food for thought. So stick around. All right, welcome back, everyone. We've covered a lot of ground today. Singtel's legal troubles, Wilmar's profit struggles, First REIT changing things up, DBS Bank going green, GIC and those continuation funds. Phew, it's been quite the ride through the market.
It has been a busy day for sure. And, I think it really shows how everything's connected, in the financial world.
Yeah, and one thing that really sticks out to me is just how much uncertainty there is right now. It's a bit unnerving, to be honest.
It's true. Geopolitical stuff, the economy being a little unpredictable, unexpected company news, there's always something. It's hard to predict what's coming next.
How can investors, even begin to deal with all this uncertainty? It seems like a recipe for stress, honestly.
It's easy to feel overwhelmed, I get it. But successful investing, it's not about eliminating risk entirely, It's more about understanding the risks, making smart choices, and being ready to adapt. The landscape is always changing.
So being flexible is key, not getting stuck on one particular plan.
Exactly. Think of it like sailing a ship through uncharted waters. You have your course plotted, but you got to be ready to adjust if the wind changes or if you run into, an unexpected storm or something.
Love that analogy. So as we wrap things up, what are some key things our listeners should keep in mind as they, chart their own course through the investment world?
Well, first things first, stay informed. Keep up with the market. Understand what's driving it. Do your research. Don't just rely on rumors or, what you see on social media. Get your information from reliable sources.
Solid advice. Knowledge is power. Right?
Yeah.
And speaking of things we've talked about today, diversification seems like a big one.
It is. Don't put all your eggs in one basket, as they say. Spread your investments around different asset classes, industries, even different parts of the world. That helps lower your risk, makes your portfolio more resilient.
So if one investment goes south, the others can hopefully make up for it.
Right. It's about balancing things out, not being overly reliant on any one thing. And remember, diversification isn't something you do once and then forget about it. It's an ongoing thing. You got to check in, make adjustments as needed.
Makes sense. So we've got stay informed, diversify, and what else? This is a lot of good stuff.
And this one might be the most important of all. Don't be afraid to ask questions. If something doesn't make sense, ask someone. Talk to a financial advisor, research it yourself, read some articles. The more you know, the better decisions you'll make.
It's a good reminder that investing isn't a solo sport, you know. There are resources out there, and it's okay to ask for help.
Absolutely. And learn from others. There are so many great books, podcasts, even just talking to other investors can be helpful. Get different perspectives. That's the key. The more you learn, the better you'll understand this crazy world of investing.
It's all about continuously learning and growing, right? Okay, I think it's time to wrap up this deep dive. We've covered a lot of complex topics. Hopefully everyone's feeling more empowered than overwhelmed.
I hope so. Investing can feel intimidating, but it can be incredibly rewarding too. The more you learn, the more confident you'll feel.
Well said. So keep learning, stay curious, ask questions. Every day in the market is a chance to learn something new.
Thanks for joining us today, everyone. We hope you enjoyed this deep dive into the Singapore stock market. Until next time, happy investing.
Happy investing.